back to these Chinese manufacturing numbers that have sent the Australian dollar lower. Let's get an initial read on them with Chris Weston from IG Markets. Chris, can you just give us your take on those numbers if you've had a chance to perhaps hear what they were or have a look?
Yeah, I just heard what you just said there on TV a minute ago. So, yeah, I don't think this is a massive surprise. I mean, it's obviously below consensus, but if you look at the HSBC flash print earlier on in the week, then, you know, we kind of got an indication that this number was going to be soft. That obviously went into the deeper contraction territory. So the fact is this is still expanding. It's just expanding at a slower pace. We did say, you know, I did see that the Aussie dollar is down about 30 pips on the back of that, so it's not a significant reaction. We've seen the Aussie weaken across the board against the crosses as well. I just had a quick look at the tables there. So, yeah, clearly the case for an interest rate hike is probably looking, given that it has risen, given the fact that the RBA are looking at external factors at the moment. The Chinese situation is obviously one that really does worry people quite severely, and I think you're going to have to look at the price action on the Chinese market today as we go in. Look at the Shanghai, because market is on tenterhooks that we need to see more aggressive policy from the PBOC. They're a little bit disappointed that we didn't get this potential 4 trillion yuan package that some people, I hadn't heard it myself, had been talking about. But you know, they want to see more aggressive monetary easing from the PBOC. They're going to be doing more on the fiscal level as well. So, but it's going to be interesting to see. We do know that the price action has suggested that the market's obviously disappointed with this number. But if we start again, you know, the weaker the number is, it sort of feeds into the argument that the PBOC have to do more, and that could be a good situation. So a weak number could be a good buying opportunity further down the line. We'll have to keep an eye on it. But yeah, I think we're given our first indication by the HSBC numbers earlier in the week. And you know, this shouldn't come as a huge shock, I don't think.
Okay, yeah, not a huge shock. Equities, though, further down, now down about 0.9%, so almost 1% lower. They reacted negatively to that news, but as you said, not entirely unexpected. No huge shock, and we will keep an eye on Shanghai when it starts trading. I guess, Chris, just the data that we're still waiting for, this was one of the 2 key pieces of information we were hanging out for today. The other was this non-farm payrolls in the States tonight. We've seen softer data come out last night, definitely to the downside. How does this set us up for this evening and these payrolls?
Well, I mean, the payrolls are one thing. I mean, before we get that data, I mean, we've still got the HSBC PMI print coming out at 12:30, which could be a worsening of that situation as well. Then we've got the European PMIs to look at later on. They're expected to tick slightly backwards as well. The European unemployment rate will be looked at very closely, because we've just seen the euro print a new low as well, and it's taken out last night's overnight low as well. And I think there's some very interesting dynamics that are going in the bond market which need to be looked at, which could see the euro take an even bigger lower leg down. So I think, yeah, non-farm's very interesting. The consensus is still 150, despite the ADP payrolls coming out below expectations. And Bernanke came out recently and said that the ADP job numbers, when they underperform the expectations, have become a much more clearer, you know, leading indicator for the non-farm payrolls. But there are some good things you look at. You can look at the 4-week moving average. That's been falling recently. You can look at the University of Michigan consumer confidence numbers. They've been falling. So from an indication, it could say that more people have been getting employed. And the ADP number did actually tick up, although it was below expectations. And I think you can look at the sort of estimates amongst the 85 economists. 195 is the top end, 75,000 is the low end. But what's important is that I think there's only 3 economists out of 85 who have actually been polled lower than last month's number. So hopefully we're going to see some job growth coming through. If it's below expectations, given the comments we saw from the Bank of Japan a couple of days ago, look for dollar yen to continue down. We're looking for that to move down to about 76. Look at gold. If we get a really weak number, the theory will be that QE comes back alive again, and that'll be announced or given some sort of indication at the June meeting. So let's have a look at gold. Gold could shoot up as well. So I think you're looking at European PMIs, you're going to look at the unemployment rate there, and then you've obviously got the non-farm payrolls. So it's this data that's coming through, and of course look at Spanish yields again, which had, you know, had a bit of a move down last night, but are still showing some very worrying signs at the moment.
Yeah, stacks of stuff to look out for still today. I did see a comment, just staying on the US for a moment, Chris, I did see a comment from Jim Rogers that we got emailed this morning. He says, if you're not worried about 2013, please get worried. He says a recession will strike and strike hard in 2013 or 2014 at the latest. What do you make of those comments, Chris?
Well, I mean, obviously a lot of it depends on Europe. I mean, you know, a lot of it for us will depend on what happens with China, which is subsequently going to get very much impacted by Europe as well. I think Jim Rogers came out with one of the greatest quotes I heard for a long, long time recently, and he said you just got to be long commodities, because if the world, I mean, this was a year or so ago, he said, you know, if the world improves, you know, then basically commodities will go up on the demand. But if the world continues to depreciate and go down, then you buy commodities because the chance of monetary easing amongst all the central banks will increase as well. And you know, if the Fed are forced to move their hand, that could be a good buying opportunity. So I think that's going to be interesting. But yeah, we've seen you know, Nouri Albini saying he sees a 100% chance of a global recession. I think the bond market is screaming this out right now. There's a huge dislocation between the equity market and the bond market. You've got fixed income yields across the developed nations at record lows at the moment. In Germany, 2 years, you've got zero yields, but the equity market is just still seeing a very, very orderly decline. The S&P's trading 1280, 1290 to 1330, 1340, whereas the bond market's just saying something very, very different at the moment. And I think, you know, you've got to go with I personally look at the bond market over the equity market every day.
Yeah, I saw John Noonan pointing that out in his note this morning as well, that divergence between equities and bonds and that different glass half full versus half empty approach. It's one to watch. Chris Weston from IG Markets, thanks for your analysis this morning.
Thank you.